but going with Jumia, we're not so sure anymore. Wait, am I mixing Jumia up now with Conga? Sorry, I'm mixing Jumia up with Conga. My bad, taking all that back. Hello and welcome to the African Tech Roundup, episode 124. This is where we round up the most important tech, digital, and innovation highlights from across the African continent. My name is Andile Masubu. So glad you could join us. And once again, alas, I'm rolling without my regular co-host, Musa Kalenga, who's busy being great somewhere else. But standing in for him is good friend of the show and one half of the founding management team at Secha Capital, Rushil Valab. Welcome, Rushil.
Thank you for having me. Good to be back in this seat, Andila.
Yeah, dog. It's really nice to have you back. For real. Thanks for agreeing to jump on the mic with me. What you been up to, man?
We just closed our fourth investment, looking at raising additional capital. It's just been really busy. Looking forward to the end of the year, just putting our heads down and planning for 2019.
Basically, boom, boom, pow.
Yep.
Okay, sounds good. Sounds good. Listen, folks, we have a special guest in the building. Rochelle, you special, but we have an extra special guest in the building. Grant Phillips, welcome to you, Grant.
Thanks very much. Thanks for having me, guys.
Absolutely. Grant is the founder and CEO of PhilTech Consulting, and he happens to be partnered with both Convergence Partners and Stockdale Street. Stockdale Street, of course, being the Oppenheimer family's South African private equity outfit. Now, he's partnering with both Convergence Partners and Stockdale Street to build out technology ecosystems across the continent. You're going to have to explain what that means in a second, but Grant was previously the CEO and chairman of CRB Africa, which of course is headquartered in Nairobi, Kenya, which is Africa's largest networked credit reference bureau and debt management outsource organization. I believe they've been bought by TransUnion, correct?
Yeah, wholly owned by TransUnion.
All right, so you did that alongside being the CEO of TransUnion's Pan-Africa business. I was actually with Lee Nike, who took over from you just the other day. And so, look, welcome to the show.
Thanks very much. Thanks for having me, guys. Looking forward to it.
Fantastic. Well, before we go anywhere, what does it mean to be looking to build out technology ecosystems for the likes of, or with the likes of Convergence Partners and Stockdale Street? What does that involve?
A good question. It's obviously quite a verbose aspiration, I guess.
Yeah.
Look, I think when you look at both outfits, they've got some very interesting investments, some very interesting assets and networks across the continent. And I think, if you look at it from a Convergence perspective, being really big infrastructure investors across the continent, I think they felt that the next iteration was how do we take that infrastructure investment and further enhance kind of bridging this digital divide and how do we get that enablement ultimately to the consumer and make a real difference.
Okay.
And I think, from both sides, I think there was a natural realization that there was a gap in terms of the technology stack, the enablement, the product suite, and the product fit in particular for Africa. And how do we go about solving that? So that's the vision. That's the dream.
Only a couple of shows ago, perhaps the last time we were actually in studio, we hypothesized that, companies like Convergence Partners might need to start thinking in consulting terms around these issues. Because when I think of Convergence Partners, I think pretty much of this pretty nimble PE outfit with a pretty impressive portfolio in infrastructure projects like CCOM, for example. And I don't necessarily think of them so much as having the resource and the intelligence required to operate in those spaces beyond just putting money down.
Absolutely.
Is that fair to say?
I think it's fair to say.
Yeah.
And I think is largely the reason why we've partnered.
Right.
I come from a very much a technology and data-driven background. And a lot of my experience on the continent has been around enabling data to make a difference and become a real impact player on the continent. And I think, obviously with the balance sheets that exist, and the obvious willingness to be a real impact investor on the continent, I think it's a very interesting fit. And I think also is we're very cognizant of the fact that you don't have to go out there and own everything.
Yeah.
You can partner smart and make
well,
a
unless
real
you're
difference.
Amazon and you kind of want to
Fair
own
enough,
everything,
fair
and
enough,
you can and do end up owning everything.
Absolutely.
Which
and I think we're quite lucky that there's not a huge amount of brand ego amongst all of us. So
So remind our listeners, for those who aren't familiar with Convergence Partners, like throughout CCOM, like what else is in that portfolio?
It's a very broad portfolio. As I say, across the continent, we've got investments in West Africa through Venture Garden. We've got operations now in Kenya as well, and really a kind of Pan-African player.
With platform aspirations, clearly.
Absolutely. And I think platforms in reality are probably the way of the future, and kind of how do you leverage platforms in a smart way to make a difference. But as I say, and as you mentioned earlier, I think Convergence historically have been very, very focused on infrastructure investment and have made some really smart investments, some really good investments that have made a real difference to the continent. And I think this feels to everyone like the obvious next iteration. And to your point is wasn't their core skill set, and I think they realized that, and I think hats off to them to be very cognizant to say, well, let's go out to the market and let's find people who can jockey this in a clever way and hopefully add some value to what we're trying to create.
I've said it before and I'll say it again. I think it's a pretty scary time to be in the consulting fraternity. Because things are changing in ways that we certainly didn't expect 5 years ago, and it makes for a really, really interesting, I suppose, viewing for those of us on the sidelines. But talk to us a little bit about the difference, perhaps, in approach and on the ground experience for the work you do within a similar genre, but for what's essentially a family interest, a family office.
So
the Oppenheimer family office.
So, I think, if you take a step back to some of my career history is I've been involved in startups historically, but most of my experience have been in kind of big blue chip organizations around the globe. And I think a lot of that organizational knowledge and kind of almost muscle memory, kind of is ingrained in a lot of the ways I approach stuff. And I think, I'm an out and out business guy. I'm not a PE guy. I'm not an out and out tech guy. But a lot of the experiences I've brought kind of resonate and are industry agnostic. And, particularly in my last couple of roles, I think, tech has been kind of front and center in terms of what we're trying to solve and how we leverage tech to do things smarter and in a better way and make a difference.
Is this old money trying to do new things?
I think in a certain way, yes, you've got Stockdale Street who have a relatively aged balance sheet, but they have a very diverse portfolio as well. This is not their
They're
first.
Not fresh-faced.
No, this is not their first dabble in technology. They have existing technology investments. I think this is the next iteration of that in terms of what is the next generation of technology. And, I don't necessarily like the term, but everyone uses it in terms of fintech. And
boots on the ground, it sounds like we actually need someone in the, on the ground with the people, like someone who actually has on the ground experience, Pan-African experience with a live network, actually like picking up what a smart play might feel and look like, which I suppose is the challenge for old money or incumbent money everywhere.
I guess so. And I think as well as it's a case of understanding is what's going to resonate to the consumer, to the market, to the client in 2020 and beyond. It's not trying to solve for today. And I don't claim to have a crystal ball. I wish I did. But I think, a lot of the experiences, particularly on the continent, is I'm quite capable in terms of articulating what the demand is. Now, that demand is evolving, absolutely, as the consumer becomes more educated, more digitally savvy, and I guess exposed to what is available in the market. And I think really what we're trying to do is how do we make that a reality in a really tangible way that really talks to digital inclusion, financial inclusion, and ultimately the upliftment both for the continent, but ultimately for our investors as well.
I'm going to say what I think a lot of our listeners are thinking, which is we need to get to know this guy because clearly he's a gatekeeper. Is that a fair assessment to make? Are you the guy whose sponsorship will be required to loosen the purse strings around such matters at Convergence Partners or, over at Stakedale?
Unfortunately not.
Yeah, and I'm totally putting you on the spot here because it's Q emails.
Yeah, absolutely. I've just seen an email from the investment committee saying you are not judge and jury. So no, we have our ICs and we have a very kind of disciplined approach to investments.
So you're a scout in some respects, and you do factor in.
I like to think I'm effectively trying to create the dream, and making the dream real.
Yes, and then you have like real sort of suits, like keeping you honest, that kind of thing.
Absolutely.
Okay. So listen, I've gone to some length to try and get to know you a little bit so that when we talk, people know who we're talking about. Rachel has had the benefit of being on the show before, and I think our listeners certainly know him quite well. Just, I suppose, two more things to loosen us up before we jump straight into some of the, more important highlights that have caught our editorial team's attention here at African Tech Roundup, and then we'll chat through those and have a discussion at the end regarding a very controversial question. Actually, quite a simple one, but controversial nonetheless. Is VC investing a Ponzi scheme? That's all coming up much later. But first, what's on your I almost said what's on your podcast. What are you listening to in the car? What were you listening to on the car here? In the car on your way here, Michelle?
I like to my arts and culture. Entertainment's usually not related to work.
Okay, which is fine.
I'm listening to Serial at the moment, the podcast. I've just started season 1. I hadn't.
You're late to the party.
Very late.
Yeah. Well, season 1 was the best one.
Yeah.
So you're in the,
okay,
so
all right.
I'm not saying it's downhill from there, but it was the best one. So you're listening to podcasts in the car.
That and Malcolm Gladwell's Revisionist History.
Love that.
That's amazing.
Dig that.
So amazing.
Really cool guy.
Yeah.
Love his books, love his podcasts. What are you listening to, Grant?
So, unfortunately, not as educational or as insightful as when I get into my car. Unfortunately, my phone automatically connects and the music comes on. So
that's all right.
Look, I think on the way here, if I think back, I think Kings of Leon were playing.
Kings of Leon, okay.
But yeah, it tends to be by and large. Absolutely, it tends to be the phone or the iPod. And
okay, so you're keeping it epic. So I just imagine your car is just. Yeah,
it's pretty loud.
It's pretty loud. Yeah. Okay, cool. Look, I'm listening to Jonathan McReynolds. He's got a new album out called Make Room. He's a gospel artist, but really, really great. I shouldn't say but. He's excellent, incredible guitarist, pianist, songwriter, etc. So that's what I'm listening to. What are you guys reading? As the final question, as sort of last.
Yeah, this is slightly work related. There's a great book called How Brands Grow, version 2. So it just talks about if you want to grow a brand, there's very concise ways of analyzing consumer trends, demographics, store shelf space, those sorts of things.
And are you reading this for the benefit of your investees?
Yeah. So trying to codify that in a way that's applicable to SMEs, because a lot of it talks about going by the Nielsen data, which costs you R1 million. You can't do that as an SME. So how do you get around that? Yeah. And then from the fun side, it's Moby Dick.
Oh wow.
All right. Yeah. What are you reading, Grant?
So I'm pretty much at the end of a great book actually called The Driver of the Driverless Car, which really kind of talks to, I guess, a view of the author around what skills are required to be successful, to be relevant kind of in the next iteration. And I think, your likes of Tesla and these next gen type of businesses that are not as obvious as you would have thought at the outset. And really, I guess behind that is what is the skill set. And it's great for me as a parent to read things like that, to understand, from a skill set perspective, is it's not necessarily about studying geography and history and all those good things. I think there's a very unique and diverse skill set that's going to be relevant going forward. So for me, it's been a great read.
I love the saying, the future doesn't care how you became an expert. I love that notion.
Yeah.
I think that kind of sums up what you're saying.
Absolutely.
In many respects. Look, I'm late to the party with this particular novel. It's actually the first work of fiction I've read in a very long time. A novel by Gregory David Roberts, Shantaram.
Great book.
So I'm halfway through that.
That's probably taking you a couple of months to get through, because it's actually literally a doorstop. It is a
doorstop, but I've actually been going through it pretty quickly. Quickly. Of course, I don't get as much time with nonfiction as I'd like, but and I haven't done it in forever. And I think it was a great choice for me. I think, But anyway, guys, with that said, assuming that we're all loose and relaxed, let's jump into some highlights, shall we? Starting with some encouraging news out of Somalia. Somalia's premier bank recently announcing at the recent Mogadishu Tech Summit that they'll be starting a $1 million fund to invest in Somali startups. So they plan to deploy that money in collaboration with iRise Hub. It's money they plan to deploy in collaboration with iRise Hub. Shout out to iRise Hub. This is great. $1 million, obviously not a whole lot, but there are people literally risking their lives to beef up the innovation scene out there. What you guys reckon?
$1 million, yeah, not that much.
From one bank, it's not bad.
Yeah, I'd love to see what comes out of that.
Yeah. I'm usually quite cheeky about, please, it's going to take far more than $1 million to fix pretty much any problem worth investing in any country, never mind a place like Somalia with has obvious challenges around infrastructure and security and other things. But my heart's out there with you guys. We feel your heat. We feel your heat, Mogadishu. Now, moving on, but staying with East Africa, the Kenyan government earmarking just under $10 million to, quote unquote, stimulate local phone manufacturing and software development. Yeah, apparently the cabinet secretary of the ICT ministry hopes that this move will cut down mobile phone imports.
Yeah, I think that's a bit of a pipe dream.
Why are you laughing?
I'll let Grant answer this.
Look, in reality, I think, the competitive landscape in terms of kind of entry-level mobile devices, which is really your mass market target, is owned by these manufacturers, and unfortunately their balance sheets are substantially bigger than $10 million. So I don't know what he intends to achieve with $10 million or what first prize looks like, but yes. Great idea. In reality,
aspiration.
It feels a bit more like a donation than it does an investment.
But I think what are the skills needed to, even if it was $100 million or $1 billion, are the skills there to deploy it? Absolutely. And if you look at what, I don't know, Apple or Samsung do, they don't even own their own manufacturing facilities. So I don't know what he plans to do with $10 million.
So again, you're speaking to something that I think is also interesting to think about. As an aspiration, is this even a healthy one? Is it a constructive aspiration to have, for your country's tech and innovation ecosystem from a business model standpoint? I mean, as a former consultant, you're already pulling some of the,
I don't think it is. I think because and don't want to sound too negative, but the ultimate outcome is it's not going to be enough money. There's going to need to be more money. And if there isn't more money, then it fails. Then the failure is seen. Look at what happens when we invest in these sorts of things. And then more money doesn't get allocated to sectors that really do need it, whether it's fintech or insurance or mobile banking, whatever that is.
And this will fail, unfortunately. It's going to be one of those things where unless you sort of spin it, it will fail. And it will be just another reason why government tried, but has decided this isn't working.
And it sounds like a good PR number. It was 1 billion shillings.
Yeah,
that's a great number.
It's great. Sounds good. Well, listen. Talking about speaking of billions, Airtel Africa, a wholly owned subsidiary of Bharti Airtel, has raised $1.25 billion. This is pre an IPO they have in the works. 6 investors, including Temasek, Warburg Pincus, SoftBank Group, quite notably, and of course Singtel of Singapore participated in the deal. If you're not familiar with Airtel, a mobile telco with operations in Chad, DRC, Gabon, Kenya, Malawi, Madagascar, Niger, Tanzania, Uganda, Zambia, and I'm just naming some. So here's the story, guys. They were valued at $10.7 billion in 2010. Aaron Fu, Mist Africa MD, asked the question on LinkedIn the other day, did Singtel and Temasek just pick up Airtel Africa for a steal at a $4.4 billion valuation? Or is the ship pretty much sinking and is this just too much to try and salvage, or even turn into a peach? What do you guys reckon? Mobile telcos, a rough business to be in. I don't know what's worse right now. Consulting, mobile telephony. Yeah. It's just rough, yeah?
Now, look, I think mobile has longevity. I think we all agree with that. And I think when you look at the continent in particular, it's the fundamental interaction with the consumer. And I think, owning that enablement platform is key. I think, to your question around, going from the 10 to the 4, the guys from SoftBank, for example, yes, they have a fund that is almost unheard of.
Yeah.
The fact that they are kind of following on is interesting even at that valuation. So, it might question whether they're bringing the average price down or whatever the case may be. But, for me, I think the interesting thing and where Airtel have actually been quite successful in the past is how do they layer on some of these value add services onto the back end of the core kind of telephony infrastructure. And I think that's really where it gets interesting on the continent and particularly, coming back to some of the stuff that we're looking at is how do we leverage infrastructure? How do we leverage the interaction with the consumer and the front end interface and really bring some of these product solutions, capabilities, enablements to the consumer on the back end of that stack.
So this is a future play. This is not about, a snapshot of this business in a moment in time.
My view is I would struggle to get to a 4.4 val even now. For me, it's got to feel like kind of a net present value. I don't know what your view is.
Yeah. Sounds like they're raising capital to reduce their debt in India because the businesses have sort of switched where India was successful and the Africa business was struggling. Now the Africa business is doing well and the India business is struggling. So they may be doing some financial engineering and trying to reduce their debt loads.
But it is a vote of confidence in the importance of this as an asset that will be key to facilitating future value extraction in these markets.
100%. And I think the infrastructure play, and that's exactly what you're doing, Grant. It's building off that for additional value adds, and it's going up and down your value chain with that set infrastructure to deploy that.
Well, let's talk about Airtel's competitor. I think they're second to MTN on the continent. I could be wrong about that. And speaking of MTN, Nigeria's Minister of Finance, Zainab Ahmed, tweeted the other day that nobody is next because we can't afford for this kind of incidents to keep happening. The minister was responding to questions of, who's next in as far as foreign entities clearly being taken to task by Nigeria's central bank in what some are perceiving as a witch hunt or an undue attempt to basically milk them for everything they're worth. It's quite interesting that the country's finance head, obviously not seeing eye to eye with the central bank in that country. MTN, in the meantime, has maintained that the Central Bank of Nigeria doesn't have the power to sanction it, and some reports claiming that MTN certainly maintains internally that, they're really being taken to task over nothing. They've done everything they can and should be doing in terms of keeping their house nice and tidy. Yeah, MTN and Oringa, this is sort of a follow-up to the story in which we touched on last time where we knew far less. Interesting times to be a large African multinational in Nigeria.
Yeah, I agree. I think, obviously MTN is kind of held the limelight in that respect for, I guess, all the wrong reasons, of the recent past. But that being said, is I think, as a business, MTN is a solid business.
Yeah.
And, they got great leadership in Rob Shooter. And I think, but it is a problem that they need to resolve. And I think it does feel that there is a substantial amount of political influence and political sway and political pressure being applied on the business.
Which comes with the territory, let's be honest.
No, fair enough. But what is interesting is to say, where you are getting the impression from relatively influential stakeholders to say, this cannot become a trend.
Well, the minister's saying it will not become a trend. Yeah. In fact, the minister's saying it's getting annoying how often I'm asked about MTN as soon as I open my mouth about prospects in my country, which is fair. And I'm pretty sure, like you say, because it's a robust business with all this potential, infrastructure potential, they'll figure this out. I'm not too worried about that. Well, moving on to another large Nigerian giant. In fact, the poster child for what a unicorn can look like. Africa's very first unicorn, of course, Jumia, the e-commerce giant. Plans afoot to IPO that business. It's not quite clear where that might happen, likely the US. This, to my mind, playing into the into the global trend led by the US, I'd have to say, of non-profitable companies IPOing like crazy, albeit fewer companies IPOing than ever before. If I gave you a busload of money right now and this IPO was happening tomorrow, how much of it would you be putting in, sinking into Jumia, do you reckon, given the fundamentals or the sadly lacking, fundamentals that speak to like solid business value of a business like Jumia?
I think I'd struggle to allocate a significant chunk to it.
Even as a play for the future, for where Africa is going, but then, the bullish mindset towards this market that has so much potential.
But that to me is private equity. Then it's not. You don't IPO to get, because then you're getting liquidity and you've got investors looking at very short-term metrics. I'm not investing, or most investors wouldn't be investing on a listed equity for the 10-year play.
Which begs the question, why is this happening?
It's really interesting because, Grant, you can say there's so much of money available to invest. So why wouldn't they go to private capital? Maybe IPOing is cheaper. Debt is probably out of the question.
Maybe we have investors who want to exit without any value being realized or any substantial value being realized. And is that a problem? I'm sort of sneaking in a throw forward to our discussion later, but some people argue that's business.
It could be, but it could also just be a signaling effect where now Jumia is a listed company and that comes along with the halo effect on their business partners that they want to deal with, and that helps them in that respect. But maybe future capital raises or rights issues coming down the line, maybe they have longer plans. I really struggle with e-commerce on the African continent because of your last mile delivery, your logistics, throwing everything out.
Yeah. And I suppose, I've also heard it argued how good this might be in a sort of backhanded way for Africa's tech ecosystem if something like Jumia got listed. Basically, it would be a blueprint for, hey, the Silicon Valley brand of venture capital works on the continent. Look, you can put money in here and exit at IPO. And of course, this works here too.
It's definitely one way of looking at it. I think for me, it just feels a little bit like them putting the cart before the horse. I think the enabling environment in Africa is not really conducive to scale an e-commerce or an e-tailing kind of vehicle at this stage, in my view anyway. The IPO route, I think, is interesting. I would question whether they would even have been able to raise sufficient capital in the PE markets. They're very revenue sensitive, to the Naira, and, that is a concern. But that being said, if you talk 10 years down the road and assuming that, these players like ourselves are successful in what we're trying to achieve in terms of solving kind of this digital divide and ultimately being able to engage with the consumer in real time. And Rochelle, to your point, in solving that last mile, which I agree with you is critical. Absolutely, there's a demand. The consumer market is out there. The demand is out there. So there's no reason why it couldn't be successful.
Well, it couldn't be 10 years from now, Africa's Amazon or something.
Look, I think if you box clever, you could get pretty close. That being said, is if you then have the challenge of having solved the infrastructure, the delivery, and the logistics and the communication with the consumer, why are you going to be different to Amazon? Yeah. Amazon can just piggyback on the back end of the infrastructure that's now been enabled.
Yeah, that's absolutely so
true.
What
about the counterparts in South Africa? So Loot and Takealot. Loot loss making, Takealot getting huge investment from
Naspers walking away from Jumia. Let's talk about that. Let's talk about how Naspers is like, well, we're good. Continuing to invest in other e-commerce players, like we'll talk about in a bit, but going with Jumia, we're not so sure anymore. Wait, am I mixing Jumia up now with Konga? Sorry, I'm mixing Jumia up with Konga. My bad, taking all that back. But yeah, so Naspers is showing that they're not nearly as bullish as the people backing Jumia, and showing so by what do you say? Disinvesting? What's the word? Uninvesting? De-investing? What do you call it when you take your investment out?
Selling.
So yeah, with Naspers is actually selling their stake in Conga, which of course is Jumia's largest competitor in Nigeria. Look, what I will say about this, in as much as there's a lot I don't like about how this deal looks and feels and all that, and some of the trends that it normalizes or potentially normalizes, I will say that overall, I can see how if you are bullish. And your bullishness is based on sort of the macros of, the African story. I can see how you might vote Jumia in the sense, they've built a brand. Even if Amazon were to swoop in sometime later, it could be a Flipkart situation where they get bought. I can see value. I just see a bumpy ride to that value.
And it's a longer term play.
It's a much longer term play.
I think it's probably longer than my preferred horizons anyway.
Yes. I think for a lot of people that might be true. How about the International Finance Corporation, a member of the World Bank Group, considering making an equity investment of up to $3 million in Nigeria's logistics startup Kobo 360? We have a fan of that business.
I love this.
In you, Rochelle.
I think this is we talk about disrupting businesses and the next wave of financial inclusion. For me, this is hugely valuable on so many respects. So from our perspective, we've got a bolt-on company. We bought a truck. The truck drives down to Cape Town once a week, comes back empty. So the asset utilization is not great, but you do it because your margins are high enough so that you can afford it. But now, if you can get your assets on demand, and for the driver there's much higher utilization. You've got a truck going full to your destination, and then they match you with someone at the destination to fill it up so that it comes back full as well. That drops your price, your cost, your logistics, and then maybe that enables e-commerce. I think for us, what we've seen, one of the highest hurdles to growing an e-commerce business in our hair care company is logistics. It costs us an insane amount to deliver products to consumers. And with things like this would be hugely valuable for retailers, consumers, e-commerce.
Is it fair to say that as such a capital, obviously not tech focused per se, as an investment outfit, you would consider a smart, maybe tech forward play in this space as perhaps maybe even your first entree into that sphere?
And that's the thinking about planning for next year, where we've learned a lot in these last 2.5 years.
Just remind people, like, what you currently have.
So we've got a hair care business that primarily started off as e-commerce and now is going on to retail shelves. It's called Native Child. We've got a biltong company called Stoffelberg Biltong, launching with Clicks. And then we've closed
a dried meat or jerky business for those of you listening and going, what the heck is biltong?
Much better than jerky though.
Yes, jerky is strange.
And then 2 footwear businesses. So looking
all
at
very logistics heavy.
Yes. Okay. So the evolving thesis for us is, yes, let's keep focusing on consumer goods, agribusiness, but maybe there's something around business enabling services. The friction within the system that we could solve by investing in a Kobo 360 and what that does. They don't necessarily just have to service our portfolio. There's obviously a wider business around that, but it just makes it so much easier when you have a trusted partner that you can rely on.
Yeah. Look, I mean, Kobo 360 was accepted into Y Combinator's 2018 class, and they also raised 1.2 million in pre-seed funding. Shout out to their founder and head honcho over there, Obi Ozo. There was also a side to the story that made me think, why is the IFC interested in this particular outfit? I mean, it also made me think, and this is a bit of a stretch. I don't know if this, how much this factored in, but the role of their investment filters or biases or even pattern matching, and how being invited to join Y Combinator is still for many investment outfits like the sort of cosign of note that signals investability without even, without question almost in many circles. What is your sense, Craig, around filters and investment sort of biases and perhaps the pattern matching regimen you've observed on the continent, and what goes in or doesn't into deciding what's worth your money, your time, and your focus?
Look, it's a good question, because you can spend a hell of a lot of time chasing shadows, and that's anywhere. That's not only on the continent. I think, for me, and speaking, from myself, and this role, but also, numerous roles previously, is I think first and foremost is you got to understand what you're good at, and you also want to understand what you want to be good at, and staying disciplined in that. I think, from an investor portfolio perspective is defining your strategic intent and understanding where you want to play and kind of where you want to go horizontal versus where you want to go vertical, and how does that work? And in the world of limited resource, where would you kind of double down, I think is important. When you look at the continent, I think what I tend to find, and this is a big generalization, but I've come across it numerous times, is you find players that are very niche, that solve problems for here and now in a particular industry, and they create a lot of hype around it, and they do raise money, and they get a lot of investment, and they get a lot of interest. The challenge that I have for that, and I think a challenge that a lot of investors have, is where you get into an environment that's not future-proof, that is not industry agnostic, that is not geographically agnostic. It limits your ability to scale. And ultimately that's, success is driven by scalability. And, there are a couple of questions I guess you could ask in terms of when you're going through that vetting process around, to your question is, how much time or effort do you spend on this? And for me, it fundamentally comes down to your ability to scale, I think, and scale clever. You don't want to get into a situation where, it's not margin accretive to grow your business. And unfortunately in Africa and the nature of Africa is it's difficult, and you come back to the logistics scenario is, delivering product is difficult. It's expensive. Delivering services is difficult and it's expensive. And that all plays into the feasibility and the appeal factor of assets. Yeah. I think, I don't want to generalize because I do believe you need to ensure that, you look at each asset in its own particular nuance and its own value and kind of pros and cons.
But if I were to press you and say, there are quite a few logistics startups out there, not all of them accepted into Y Combinator. Does that somehow signal to you this is one to make a phone call to? Or?
Look, I like the idea, and I was going to.
And for better for worse, I don't think it's necessarily a bad thing. But I was going to kick Rashil on the knee because we should talk, because Logitech and logistics and technology and logistics is one of the key fundamental pillars and industry verticals that we're looking to expose ourselves to, because it solves so many problems for so many industries and it's scalable. Yeah. So it's a really interesting space, and absolutely. That would definitely be something I'd ever do.
Grant, how much weight would you put on, if a company came to you in your pipeline search, someone with a specific incubator, accelerator, or investor, if their previous rounds or their previous support came from Y Combinator, would that influence your due diligence or your view of the company?
Same question, different way. And I think the answer is yes. I think it gives you confidence to a certain extent. But that being said, and I mentioned it at the outset of the chat, is that my investment committees are, Grant's got to put his name to something, and would it give me confidence that they've been involved in incubation or that they've been stress tested previously? Absolutely. Is it necessarily going to change the breadth and depth of a DD that I would do? Probably not.
Yeah. I have a slightly different view, because we look at much smaller businesses. So you see a lot more companies applying, and this is the white paper that Andile shared with me, but the hubs and incubators.
Yes, shout out to Hyber and Thomson Reuters and the rest of that. I'll actually find it and just shout out the name of that paper.
Cool. I think when you see small startups applying to these programs and the terms in which they get investment, or if they get it at all, it's usually just support. I can't understand the motivations and incentives for hubs and incubators to grow businesses. I think the struggle that we have in terms of finding pipeline and good investable companies, and I think that's broadly speaking across South Africa. What is happening in these companies, and why are startups applying to them for support, and then what's the outcome? So I'm hesitant when someone says they've joined a incubator accelerator. Well, what was the value that you got out of that? What equity did you give up, or what's your growth trajectory been? I think there has to be a lot more it probably raises more questions on my side than if they weren't part of that program.
Except in this case, we're talking Y
Y
Combinator,
Combinator,
which
of
is
course,
of course
yeah,
different.
yeah,
But I think
yeah.
the point, I think it's worth interrogating still.
No, and you bring up a very valid point, and personally, I've never been a huge proponent of incubators and hubs because I don't believe their success rate has been fantastic. And I think quite often a lot of these startup businesses go into these incubation environments not really understanding what they want to achieve out of it. And all too often, their fundamental goal is to raise money. And that is not the purpose of an incubatory environment. You know, it's there to enhance your skills that you don't have as a startup business. It's there to network. It's there to kind of fundamentally understand how you take your business, you know, forward over the next 2 or 3 years and what you need to do to make it successful. So, you know, for me, I think, you know, this is a different example and one that has been stress tested. And I think the model is relatively self-explanatory and quite easy to understand. But I think, you know, and I do caveat this in that, you know, we are not seed or venture capital guys, you know, so inevitably the investments that we tend to get excited about have sufficient data points behind them to kind of give us comfort that we know with a relatively high level of confidence that we know what we're getting into. But look, there are some great hubs out there. There are some great incubators out there, and there's some really good businesses that have come out of them. But back to your comment, Rochelle, is what have you had to sacrifice to get there? And I think all too often desperation sets in. You're starting to run out of money. You kind of you hitting closed doors, and you don't really know how to network. And
you also have maybe misaligned expectations of what participation should deliver.
Absolutely.
You know, so you make a judgment call on the basis of a flawed perception of outcome.
Absolutely.
Yeah.
Absolutely.
And I suppose the reason I raise this is because I suppose this is more an ideological debate in a sense where I'm like, on some level, I'm concerned that we are outsourcing the priorities of ecosystem growth that we should actually be shaping as a continent, you know, and that should be rooted in actual business value. And I think no shade against Y Combinator in this particular case. I mean, their track record stands for themselves. But if it came right down to it, I'd sooner trust my money with you, Rochelle, than Y Combinator's fund because of my fundamental belief in your commitment to market relevant value creation. I just don't trust necessarily some of the doctrines that, you know, Silicon Valley stands behind in terms of like creating value and the narrative around what a successful business may or may not be.
Sure.
Because there's a lot, you know what I mean?
Yeah, that's also a good tease for your big talking point about is VC a Ponzi scheme, right? So who do you trust?
Yeah.
Do you trust Secha Capital to be the investor and then mark up the round? Would you trust for the next round for Kobo 360 because they've gone through the IFC's vetting process and their growth? Then do you trust them as the next round?
And IFC obviously trusting that they've been stress tested by Y Combinator. And I suppose it goes without saying that Y Combinator wouldn't touch them if they didn't perceive Silicon Valley level scaling potential and sort of exponential growth potential and all that kind of stuff. So listen, shout out to, like I said earlier, shout out to Matter Innovation, Hyber, AudienceNet, and who have put together a pretty awesome report. We'll have it in our show notes. The Africa Innovation Paradigm, a report they've prepared for Thomson Reuters on fixing the ecosystem for the many, not the few, as they put it, an assessment and framework for transformative change. We're really just skimming the surface of some of the ideas that are put forward in that particular document. And we will no doubt be returning to some of these things in future episodes. But yeah, really nice to get your guys' view on that. Moving on now to South Africa, where, you know, Amazon Web Services has announced that new data centers will be set up in Cape Town come 2020. They should be ready to go in the first half of the year. Currently, AWS provides 55 availability zones across something like 19 infrastructure regions worldwide, with another 12 availability zones across 4 regions in Bahrain, Hong Kong, Sweden, and Of course, the US also expected to come online in the coming months. So this is really interesting. Reading the press release, they talk about, their satisfaction with the fundamentals that inform where cloud adoption is going on the continent and how this is a good time. Of course, they're not here first. Well, they've been here in some shape or form, but the likes of IBM doing their thing here on the continent in terms of data centers, etc. But all in all, good news. I mean, this plays into the infrastructure space you're probably most interested in, as far as your partnership with Convergence Partners, Grant.
Absolutely. I think, and we mentioned it earlier, I think the world is going platform. The world is going everything as a service.
Yeah.
And really cloud is the fundamental enabler for mass adoption of that. So great news. I think, my friends at Silicon Cape, they've obviously done a lot of work, back from day dot to get a lot of interest and a lot of hype around what we believe is on offer and the potential that the region actually has. And I think the fact that the likes of Amazon have kind of adopted that is really, really interesting. And I think in the medium to long term is huge kind of tick box in terms of, is sub-Saharan Africa really a high growth opportunity? This is a fundamental enabler of next generation growth. And I think it's a great news story.
The impact of players like Naspers, players like, now foreign players like AWS coming in and sort of backing the story that Silicon Cape has started to tell and sort of holding that story down with a very real business story. I mean, you don't get much bigger than Naspers, Africa's biggest tech company by many metrics. They've been a big part in the background of ensuring that, they support the notion of entrepreneurs plugging into a very real scene and into a very real business scene. I was reading recently some of the numbers. Just 10 years ago, Naspers' revenue was 89% of it made up of publishing and media. Whereas today, 79% of its revenue is derived from e-commerce and internet businesses, and that's growing. One would be remiss if you didn't point to the influence of companies like that or real fundamentals of that nature to making a Silicon Cape more than just this lovely idea of, making the Western Cape the place to be if you're in tech,
Yeah.
So,
I think it's a good point because ultimately every startup is trying to create a business. And a business is a big thing. A business is not an idea. It's not a product. There's a lot of stuff that goes into creating a successful business. And to your point is, without the backing and the genuine support, and that's not only financial support, it's genuine belief and investment into these types of initiatives with companies like Naspers is, a lot of these initiatives would never get off the ground.
Again, to cite Naspers, they've just announced that they'll be investing just over $315 million in South Africa's technology sector. Of course, the bulk of that is said to be allocated to the development of existing tech businesses like OLX and Takealot and Mr. D Food. But apparently just under $95 million will be committed to something they're calling the Naspers Foundry. I'm not going to stand here and sort of preempt how successful they'll be at sort of corporate-led innovation. But I think they've quietly been sort of sowing the seeds of, we're part of this vibe and we're part of enabling it. And, I can't hate that. Staying with Naspers, I think there are quite a few notable things news-wise that are worth sort of noting as well. They've been criticized, obviously, for being heavily weighted in their interest in Tencent, the famously profitable Chinese firm. Not too long ago, reduced their interest in that business by a smidge, netting them a cool 9.8 billion, taking their interest. How much?
For 2%.
Yeah, for like 2%. Yeah, no, nothing much. 2% of Tencent.
The business that they bought for what, $30 million?
Yeah, man, that was just
Crazy
insane,
story.
man. So via an accelerated offering to investors, they raised $9.8 billion, and they're definitely throwing it about. Naspers We Buy Cars investment via OLX at $95 million. Naspers also apparently betting that they can help create a new Craigslist by backing Letgo, the American mobile classifieds app. $500 million they're putting behind that. Of course, they've set out to list and unbundle their video entertainment businesses under the banner of the MultiChoice Group. So MultiChoice South Africa, MultiChoice Africa, Showmax Africa, and Aditu will be under that banner on the JSE quite shortly. And then, they're looking to increase their stake in Swiggy, which is strange because, I shouldn't say it's strange. I'd really love to be a fly on the wall in that boardroom, like just what's influencing their decisions to divest here and invest there. And so it'd be fascinating to understand, for example, why Swiggy, why an online delivery food service in India, and what sort of bets are they making long term beyond this? And all the while, people just baying at their heels, going, "You guys can do better. You can do better. You're a bad bet. You're a bad bet. You're heavily weighted in areas that aren't showing growth." And what do you guys make of Naspers in general?
I think the thing through the discussion that we've been having is how this enabling environment that you talk about helps the businesses that they're underlying. Yeah. And for me, that's the new wave of investing, and obviously speaking our own book as Setcha Capital, where it's the skills transfer that's very important. It's the opening channels, the Stellenbosch effect it is. Yeah. And I think it's what you're doing, Grant. It's having that physical backbone infrastructure that they can plug into. It just makes the entrepreneur's life so much easier. And I think for Naspers, they've got some amazing people in the ecosystem to help them grow, and that's probably it.
And a ton of money too.
Yeah,
I have to say, like a year ago, I would have been one of their critics. One of their critics around, just failing to make the most of the advantage they have given their scale, and really just how easily they can tap, say like $9 billion at the snap of a finger. But I think I'm seeing moves now that make me think, okay, watch your back, everyone else in the world that's at their level, because they're not lying down. They will not lie down.
No, I think it's very true. I think they do have the luxury of a substantial war chest. And I think also their track record speaks for itself. These guys are the kings of pivot. Yeah. And, they've successfully changed their revenue mix and their value mix into next generation assets. And I think that's really, really interesting. So, I agree with you. I think it's one to watch, and I've never been a massive proponent of the underlying Naspers business. So if you kind of looked at the non-10-cent piece. Yeah. But I think now when I look at their asset base and what they're doing in terms of spinning off some of these businesses and diversifying. And really, absolutely, yeah. So I think it's almost to watch the space. I think with the war chest that they've got and the fact that they've got this very kind of next generation mindset at an executive level, I think it could be an interesting one.
Listen, Angola, we see you, fam. The South Atlantic cable system recently went live. It's 100% owned by Angola Cables. It's open for commercial traffic. It's the first transatlantic link between Africa and the Americas. According to the company, the cable offers 5 times the speed of existing cable routings, reducing latency from Fortaleza in Brazil to Luanda in Angola. So Luanda, you can now connect to London and Miami with approximately 128 milliseconds latency. Sounds good to me, man. Sounds good to me. I'm hoping to meet some of the people behind this company fairly soon. I hope that lands. I suppose we need more, points of presence across the continent. This is good news, but we could see more, I guess. Yeah. Yeah,
absolutely. I think, with us being relatively a fay in the space, I think the infrastructure play is kind of a fundamental building block in kind of this next generation that we keep talking about. So,
CCOM's got more competition.
Absolutely. But, competition's good. Competition is good. And I think for us is, when we look at what is the next generation of the investments that we're going to make? I think, whilst we'll still obviously continue to invest in the core, and that's the fundamental of the business and the mandates that we have, I think you're going to see a lot more exposure in terms of what does that infrastructure enable, and how do we play a part in accelerating the delivery of that?
I see sort of Luanda's story going the way of, what's happened in Marseille in France with regards to the business potential that infrastructure like this can deliver to a city. If you're not familiar with Marseille, beautiful city, by the way, got to visit recently, and definitely, quite interesting to see how, again, as you say, infrastructure makes a massive difference. So well done to you, Angola. Would love to see what changes this is going to usher in for Luanda, for the region, for the country, certainly, and the rest of us nearby. Zambia's central bank has warned residents against trading cryptocurrencies in that country. Well, they're joining a long list of countries on the continent that have made similar warnings. Kenya, of course, quite notably. Nigeria, of course. South Africa, quite interestingly, Swaziland, actually renamed now Eswatini, more appropriately, I believe, have more favorable stances towards cryptocurrencies, which I think is a good thing. If you guys were Reserve Bank governors, or Reserve Bank deputies, or even finance ministers or deputies, pick any one of the larger countries on our continent, some of the bigger economies, maybe Ethiopia, Nigeria, South Africa, what would your attitude be? What's the most constructive standpoint to have around this? Because they're very real risks. We know that this digital assets debate is one we'll unpack in a future series. The notion of digital assets has now been made synonymous with cryptocurrency, which again is also synonymous with just a wide range of very problematic, everything from very problematic to quite constructive and clever. All lumped into one thing. And of course, if you're a regulator, you look at this and you go, if you're a Zambian central bank official, you go, don't do it. But what would you guys do?
Every time I'm on the show, you ask about crypto, and every time I say I don't understand.
I don't understand it.
It's been a year, and I still
haven't wrapped your mind around it.
It's quite interesting because I think that's actually part of the answer. Is first of all, let me caveat this, and I think there's zero likelihood I'll ever be a finance minister or anything like that. But my advice is, would almost be is understand it. People are scared of stuff they don't get. And Rachel, I was in kind of your shoes, a year ago, and people were saying to me, well, are you invested in Bitcoin? I'm like, well, I can't invest in stuff I don't understand. And that kind of
so not even a little bit, like you don't have some lying around somewhere.
So that was 12 months ago.
Oh, that was 12 months ago.
That was 12 months ago when the price point was
Have you joined Hodl Gang?
You will have to if you invested last year.
Yeah, exactly. No, so I think for me is and I almost take a step back from the cryptos themselves. But the fact of the matter is blockchain is here to stay. And I think the sooner that regulators, whether they be financial or market or whatever the case may be, is the sooner they accept that and understand that, the better. So, blockchain is a great enabling tool. It's a great security, and particularly in cybersecurity tool. And cryptos really are just a derivative or a function thereof. Yeah. From a regulatory perspective, it is difficult because there is a lot of anonymity on the back of it.
Yeah. I also feel like there's also a misplaced desire to capture value in ways that are unhealthy, to, again, the notion of just doing business in the way business should be done, which is value-led, and I think that might be, if I was a finance minister or a Reserve Bank governor, my concern that there's a reframing of value assignment, value capture, and the trade of value, right, that's on the go right now. And a lot of it's not healthy or formative to the digital economy we want to have. And so from that standpoint, I do really feel for them. I really do feel for regulators and policymakers who have to think about these things, because on some level, yes, get out of the way of the innovators, let the market write itself. But man, I think we have far less of a safety net than, say, a Taiwan or or the US, where this whole thing could implode on itself to absolutely nothing, like 2008 style, and they'd still be okay. We'd be holding a baby, in a way that they, other parts of the developed world aren't, or more developed world. So yeah, that's how I kind of think of it. I have some empathy for governments like the Zambian government, who, listening to this, are probably going to go, "You tell them, Andile." But no, I mean, yes, to your point, again, we have to learn. I didn't get to this point of empathy by sort of watching from afar. It was being around people. It was buying a little wallet with like 2 rand in it of Bitcoin. It was just coming to the sense of, reading some of these white papers or parts thereof, having smart friends who read them for me and things, having them on the show. And I think it's really important that policymakers see this as part of their role, and a learning role.
Yeah, it's not going away. I think that's the fundamental is it's going to need to be regulated in some way, shape or form in the very near future because it's, like it or not, it's here to stay.
That's true. Shout out to you, Liquid Telecom, for completing the acquisition of CEC Liquid Telecom. It's a Liquid Telecom Zambian subsidiary. The telco has bought the remaining 50% stake from the Copperbelt Energy Corporation. Liquid Telecom serious about this Cape to Cairo. We're going to dig up Africa and sort of lay fiber and bring our network footprint to bear. What do you guys make of Liquid Telecom's moves in this space?
Yeah, look, and it comes back to an earlier comment that I made is any business who's investing in the enhancement of infrastructure and the extension of the breadth and reach of enablement, love, it's like perfect, guys. Keep running. An interesting point is their intentions in Zimbabwe around kind of creating digital access for students. Yeah. One of the other areas we're looking at is education and edutech. I think, for us, it's really interesting. But without the likes of our friends at Liquid, it's incredibly difficult.
It's a pipe dream, actually.
Edutech only exists if someone can access the tech. And I think, for us, we believe that is a fundamental enabler to empowering the next generation of Africans. And, whether it be through education, access to services, if our friends at Liquid or anyone else out there is continuing to invest in the infrastructure that's going to enable that, kudos to them.
Dig on.
Dig on. Please leave my pavement.
Yeah.
Can I pause you for a minute? Use the bathroom.
Sure. So we'll have to pause. Are you struggling? All right, so guys, let's speed through to South Africa now, where the equity crowdfunding startup Uprise.Africa has secured funding from the Silicon Valley firm Nexus Ventures. They haven't disclosed the amount, which we hate. I usually don't even speak of matters that aren't disclosed in that area. But the reason I'm bringing this up, and I know you're plugged into some of the folks behind this deal, or at least involved in it, so you might have some insight, Rushil. But the reason I'm bringing it up is crowdfunding as a trend, clearly finding some traction on the continent. I have to admit, I was one of the less than optimistic or mostly skeptical, types when it came to this notion. Where it would be positioned? Is it a good look for a firm to sign up for crowdfunded, finance? What does it say about the founding team and their inability to sort of bootstrap to a sort of sustainable level? But it seems to be an idea that's gaining traction.
Yeah, I think Visa and the team have done an amazing job. I think I'm with you on the crowdfunding. I've sort of pivoted that it offers additional avenues to raise capital for startups, maybe less expensive, more democratized version of that. Yeah. And everything that I've seen to date has been, 100,000 Rand, 200,000, 500,000 Rand. So nothing really meaningful. Mm-hmm. But from this press release, they've raised 3.9 million Rand for a brewery, and the funding at a valuation of 60 million Rand. That's really exciting. I think this is how you do crowdfunding properly, I think, for
responsibly.
And real startup size businesses that need the funding, rather than these small piecemeal.
Well, with you, this is certainly in your space. When you think of the brewery, that's kind of like a business that would tick all the boxes for you, FMCG, the size and scale of the things I know you're interested in. Do you see a platform like Uprise.Africa as being potential competitive?
Source of pipeline? No, I think source of pipeline, because I think the previously looking at other crowdfunding platforms where you're raising 100,000 Rand, where's the company going to grow to next? Even if they want 1 million Rand, it's still too small for most players. But if you're looking at companies raising 3-4 million Rand at a time, when they grow to the next round of funding, that's going to be at a 8, maybe they need 8 million Rand, whatever it is. Yeah. Then it becomes more interesting to a lot more players.
Yeah. Well, staying with important investment news, the education fintech play Prodigy, a UK company, and the reason they've made it into our news, our Africa newsreel, is because, of course, their, Rand Merchant Investment Holdings corporate investment arm, Alpha Code, has invested in that particular company. Now, really interesting play here. They've landed $1 billion worth of financing in 12 months. And get this, it's not private equity, it's debt, right? It's a line of credit. The financing consisting of $900 million in institutional debt facilities provided by Deutsche Bank, Goldman Sachs, and others. And then the remainder, of course, coming from other investors, including schools, family offices, and high net worth individuals. Yeah, I mean, for those of you who don't know, Prodigy Finance, they're essentially a fintech platform that enable financing for, international postgraduate students who attend participating business schools or postgraduate institutions. And I actually met someone who had financed her master's at Oxford via this very platform. And it got me thinking, when is it good to do what Prodigy is doing here with this debt play?
The debt play is more a credit facility so that they can access more consumers. It's not a direct investment into the business. It just allows them to deploy a lot more capital.
It does require them to be pretty confident about their business model, right?
Yeah. And I love the impact story of Prodigy, where they're taking credit risk scoring in countries that the banks maybe don't have that information and using a smarter version to do that. And just a personal anecdote, when I went to go study overseas, I went to a bank and they offered me 150,000 Rand loan at 18% interest. And if you think of the fees that you pay overseas, that's not even 10% of what it's going to cost you. Yeah. And at 18%, something like this is hugely valuable. And I think hopefully the students from Africa going overseas will come back, bring those skills home. And that's how we end up growing the continent. Yeah. But to your question, VC versus debt, I don't know.
Yeah.
I think it depends on your business.
Depend. Yeah, I know you'd say that because what you're investing. Yes, because you're a consultant also. Yeah. But I mean, you're also in the business of basically, I suppose you're building a business that involves sort of essentially deploying VC. So on some level, you're kind of biased. Sure. But what do you reckon?
A couple of things. I think first and foremost is kind of what stage is your business at? It's like, so how much do you need? How many data points do you have? What are you going to use the money for? And the second thing is what comes with the money, because that's also critical from an investment perspective is, what is your requirement in terms of access to your finances, in terms of their skills and their learnings and their networks. Yeah. If you're confident that you're in a scale up stage, then, by all means is, come and speak to us and, we can give you money. We can't necessarily commit in terms of excessive amounts of times or access to our networks and the like. But if you're really early stage and you maybe seed and you maybe start up or whatever the case may be is, and I'm going to say quite often, but it may be sometimes, the access to the IP behind the money is actually more important, more valuable to your business growth story than the actual rands and cents. So, for me, I think it's a balancing act is understanding, A, where you can find your money in terms of the stage of your business, but then also personally, almost more importantly, is what does your business need outside of the money to get you to point A?
Gotcha. Well, let's speed things along, guys, because, there are a couple of things I want us to touch on before we delve into the question. Is VC a Ponzi scheme? All right. Well, Standard Bank in South Africa has confirmed that they'll be launching a mobile virtual network operator. A quick one, guys. Thumbs up, thumbs down. Do you think this is a plan? They're no doubt looking over at First National Bank going, that might be working for them, or certainly a play to taking on mobile telcos who are quite happy to veer out of their lane into ours. What do you guys reckon?
I think it's interesting. I think it opens up a whole new client base. It opens up a whole new distribution channel. It's an expensive way of doing it. Yeah. But to your point is, the lanes are converging. There's no longer MVNO in one and financial services in another. It's, the Safaricom and Pesa kind of model is now in real terms. So I think it's interesting whether it's good or bad. I think only time will tell, but I personally think it's probably a good call.
I wonder what's the rationale behind it, because initially they said when FNB was doing it, no, they're not really interested. Obviously, FNB has their own reasons. And when I was at FNB, it was around retention. So you want your cell phone number to be tied to your bank account so that your consumer stays longer with the bank. But now with the low cost of switching, I don't know. maybe there's other reasons behind it.
Maybe they're also setting up a future where you might switch banks the same way you switch mobile telcos. And they're setting up for that future where when it comes down to it, you're not moving from Standard Bank to MTN, but staying, you know, I don't know. Maybe that's part of it. Yeah, so Malawi's plan to force businesses to accept digital payments. We don't have time to discuss that, but there's this plan on the books over there to try and insist on retailers and traditional sort of business infrastructure to basically prioritize digital payments. This is, you know, I suppose they're trying to force innovation as far as financial inclusion. What do you guys think? In spirit, are you with lawmakers in this regard? Do you think, you know, it's part of their fintech policy governance plan?
Encourage good, enforce not so good.
Yeah.
I think maybe a bit too early.
Yeah, it might be too early. Yeah. All right. Well, here's a nugget for nothing. Andela apparently pays coders 50%. Coders, obviously on the continent, 50% less than they would pay a coder in Silicon Valley. How do we know? Well, that's because, and the reason we're outing them in this way is because we asked them here on the show to give us information which they didn't, and they shared it on a podcast in Silicon Valley. So we found that quite interesting. So here's a question for you, African Tech Roundup Village. How do you feel about arbitrage, talent arbitrage? Do you think it's right that an entire business model be based on the fact that you can get cheap labor here and basically service clients in other parts of the more developed world? Do you think that's right? Do you think that's cool? Is there a moral problem? Is it just good business? You tell us how you feel. We'd particularly love to hear from the likes of the folks at Andela, the folks at We Think Code, who of course are not for profit, so they have a slightly different model. But we'd love to hear from folks at Gabea. But in general, we'd love to hear from all of you. Give us a shout at African Roundup on Twitter, facebook.com/African Tech Roundup on Facebook. And of course, drop us an email if you like at hello@africantechroundup.com. Now, some quickfire things before we head into our discussion. Top executives leaving Facebook, the latest of which is Brendan Iribe, the former CEO and co-founder of Oculus. He announced his exit most recently. Is it naive to think that you could sell something to Facebook and it not lose its soul? What do you guys reckon? This is a yes or no. Is it naive or is it not naive? Absolutely naive. Okay, so I'm team naive as well. So good luck to all of you. It's turning into this whole trend around, you know, why I left BuzzFeed type situation where all of these former founders, from the Instagram founders to the WhatsApp ones to a whole bunch of other executives over there, all taking their turn in the media spotlight, sort of going, well, this is why we left. Well, boo-hoo to you, Mr. You know, most of you are billionaires, and we wish you well. Hopefully, your next round. There's a lady on the list. There's a lady on the list. So yes, so all the guys and gals who have just recently left, we look forward to seeing you do amazing things after you've left. Facebook, the data breach, they're in good company, folks. 50 million accounts compromised. They're not alone. Cathay Pacific, FedEx, Orbitz, the travel booking site, Twitter, T-Mobile, Uber, government, flipping everybody. Is our privacy overrated at this point? Yes or no?
No.
I believe so too. But has the horse bolted in terms of protecting it wholesale? Yes or no?
I think there's a way to go still. Hackers are getting smarter.
Yep.
No idea.
Okay, so he's not, well, Rochelle is non-committal. The horse probably has bolted. He just doesn't want to admit it. According to Bloomberg, Spermico chips loaded with Chinese spyware have been used to hack Amazon and Apple servers. Apple, of course, totally denies this. They also deny the fact that they're under some kind of gag order preventing them talking about this. So Bloomberg quite, hectically taking them up on this. At this point, it's one or the other's lying. I mean, Apple's put out a very emphatic sort of public response to this. It's one or the other. Bloomberg is fake news, or Apple is lying about their data security. Which one is it, guys?
Who knows what to believe nowadays? Really,
so it's a tough call to make, right?
It's a very tough call.
Bloomberg's pretty solid.
Yeah.
Apple,
you've got to assume they've tested those chipsets, and so it's I'm on the fence.
Well, one thing is for sure, Apple has been fined by the Italian government for planned obsolescence. They were hit with a 10 million euro fine. Samsung themselves also being hit with a fine, but smaller, 5 million euro. Look, it's official. These guys have been convicted of essentially flooding older devices with software that will slow those devices down and incentivize the purchase of new ones. Alongside this debate is also the fact that the likes of Apple, Tesla, and others, laws in America certainly coming online in certain states to prevent them from essentially preventing people from fixing their own devices or being overcharged for buying new things, when you don't need to because, you kind of have to because you can't fix it yourself. So, yeah, what do you guys reckon about that? Do you think this is fair? Apple about to appeal? Do you think Apple, as they have stated through their legal teams, didn't see this coming? They didn't have any intention of slowing down our devices, and this is not part of their business plan. So one or the other. Either Apple is really slowing down our devices to force us to buy new ones, or they're not. A or B?
It's a consumable. I think they either make a weaker screen or they slow your machine down. They've got to get you to the point of sale as quickly as possible.
I think, how do you sustain Apple's share price growth without you buying a device every year or 2 years?
I agree. I absolutely agree. Shout out to you, Kareem, for being in the sights of Uber. Kareem, of course, the ride-hailing service from Egypt, according to anonymous sources close to the matter. Again, according to Bloomberg, if you believe them or not, the deal could value Kareem at about 2 billion, 2.5 billion. Other sources state that plan is stuttering. Are you in support of Uber's global trek to world domination? Yes or no?
Yes.
No.
Airbnb wanting to share equity with home sharing listees. What's the story here, folks? Well, Airbnb wants to change how business is done. They want to truly democratize, what is so far a highly centralized activity, which is the ownership of some of the most prized tech firms in the world. Airbnb suggests, they would like to share their shares with, people who make their company work, i.e. the people who open their homes up to people. And the problem with that, of course, is the SEC and most other regulators around the world see this as a problem because that's just not how things have been done in the past. Are you a fan of this notion, Rochelle?
I'm a huge fan. And I think that the reason why the SEC has a challenge with this is Airbnb's hosts aren't employees or shareholders. So how do you give them equity? So that's the rule that needs to change. But for me, this is I'm a huge believer in aligning incentives. And this goes a long way to doing that, building loyalty on the platform and growing the company. I think it's a fantastic idea.
Absolutely. I've come across a great South African startup business, 3 incredibly smart guys who are doing just that. They're matching landlords and tenants and empowering the communities around these neighborhoods, from a retail perspective as well, and creating this real loyalty and engagement model with the loyalty aspect, obviously, but then also with the remuneration aspect and a data play around, the better you are as a tenant, the more, discounting you can get, or the more free perks and free QIs or whatever the case may be. So fantastic model. I think it's going to be a great business. So I'm a firm believer.
So I like this because it leans into the whole trend towards steward ownership as a model of business ownership, as opposed to having disconnected, almost uninterested investors sort of try and invest in things in order, to get like a buck out of a situation, as opposed to actually have people who are invested in more ways than just the money they put in and the time they put in. But, in terms of that brand. So I like this for that reason. However, this also plays on some level dangerously into where China's going, or China's been for a while, in as far as basically digitizing what it means to be a good citizen, and a point system that allows you to gain certain benefits as a citizen if you're a good, quote unquote, good citizen.
It's gamifying morality.
Gamifying morality. I love how you put that. So I do think there are genuine concerns that regulators have to observe here in terms of determining how far this can go or should go.
Gamifying morality. I might have to use it at some point if you don't mind.
Yeah. Because what if the community just doesn't like you and starts to what if a bunch of the community start to just give you bad ratings? Which
don't you just have to worry about Big Brother though?
Oh my word! Yeah, so just doesn't sound. Yeah, so there's ways this could go wrong. Yeah. There's ways this could go wrong, but I suspect this is good PR for Airbnb, who are all about democratizing travel and tourism. It's a good look for them. They probably know it's not happening anytime soon, but they've definitely made some headlines doing this. Yeah. So let's talk in the last few minutes we have about this notion of VC being Ponzi scheme, ? Is it? The American of Sri Lankan descent, Chamath Palihapitiya, Chamath is famous, is a famous venture capitalist and founder and CEO of Social Capital. He was an early senior executive at Facebook, joining the company in 2007. He left them in 2011. He's also an owner and board member of the Golden State Warriors, the basketball team from the States. And yeah, he's a billionaire. And I recently watched an interview he gave recently where he basically said, he now believes firmly that the VC game is a Ponzi scheme. And up until recently, this guy ran a top 2 hedge fund in the US. In the last 8 years, he's made double what Warren Buffett made in the first 8 years of his company, Berkshire. So he's saying this at a time, not when he's like, he's in a slump and things aren't working out and he's looking to pivot. He's looking for a PR pivot. In business terms, he's doing better than he's ever done. But as he puts it, ideas, people, doing things is more important than, just having this insular investment debate about where and when to dump money on something, how to chase great IRRs. And so, yeah, which begs the question, folks. I've got 2 investors in here. Is VC a Ponzi scheme?
My initial reaction is no. I agree with what Chamath is doing. I think the way he's setting up Social Capital is the exact same way that we've set up.
Or deconstructing Social Capital. Because that's what he's done. He started this big thing. He started the small thing, what it is now. And then it turned into this massive thing, which he totally hates now. He's dumped everything and he's now deconstructed it to bring it back to what it was. So
I agree with what he's doing and the holdco structure, holding company structure where you don't have management fees and carry or profit share. So for me, that's the way that you align incentives with your investors, your investee companies. It just allows you that much more flexibility. I don't agree with the way he's done it. I mean, he helped build Facebook and then said, Facebook's the worst thing in the world.
Yeah, he basically crapped all over them. He's
doing the same thing here. So maybe his approach I don't agree with, but I think the end result is something that I fundamentally agree that chasing the management fees just doesn't give you the right incentive to invest in the right companies, and then it causes the follow-on rounds and the up valuations that you have to chase to get bigger and bigger assets under management.
So background, yes, to your point, he literally woke up one day and went, I don't need you all here. Like he looked at his office and said, I don't like these people. I don't need them here. I want to go back to everything I built before. And he basically says, that's what I'll do. And because he's a billionaire, he could do that. And he broke a lot of hearts doing that. But like you say, it's an approach thing. But at this point, no LPs, great partnerships remain. He's picking investments based on value with no cap on the finance and growth support they need. That doesn't sound like a bad thing. What do you think, Grant?
It doesn't at all. But I think we've got to kind of contextualize this up front is the guy's worth $1.2 billion.
Yeah.
Okay. And he's made that out of pure capitalism. So let's be pretty pragmatic around, people in stone houses and all that good stuff.
Yeah, you're like, so, that's rich coming from you quite literally.
Exactly. Yeah, so, I think I understand his point, and I do understand the challenges around up rounds and this artificial inflation of valuations and multiples, and it does get crazy, and we've all seen it.
Okay, so let's pause there and just unpack that a little bit. So what's unhealthy about what you just described? So what's happening?
So it's very similar to how he's defined it, and I guess one of the concerns that he has is that the fundamentals of the business and the fundamentals that if you go back 10 years ago, how you would value or evaluate a business no longer exist. Or they're no longer as weighted in the valuation cycle as what they would have been in a more traditional environment. Now, that's not necessarily a bad thing, okay, particularly in early stage where that's almost impossible. But the challenge that I see, and I guess the challenge that he highlighted, and maybe the reason why I've kind of opened my eyes to it, is you get into the situation where early stage investors have to start recognizing subsequent rounds to value up the assets in their book. And there is a fee attached to it and the like. And there is an element, particularly in the US, of this kind of club.
Also, the Jumia thing we cited earlier.
Come with me.
Basically,
absolutely.
Yeah, let's pump this up until all of us can exit with money in our pockets, but we don't necessarily have to have created value as part of it.
Correct. And also, I think what you're seeing now is a lot more money coming into private equity out of the stock markets. I think there's a few companies being listed, and you're seeing a lot, particularly the bigger companies, their real value is being generated in the private equity space. So your likes of Uber, for example, is, they got an $80 billion valuation, whatever the case may be, is when they list that's not going to jump to a 200 or a 300. So all the real value is being created. So you are seeing a lot of traditional market capital being pushed into private equity, which is kind of driving this self-fulfilling prophecy of these crazy valuations, because they want to be part of the action, and they've got some serious capital behind them. Is it real?
Stories sell. At this point,
stories sell. And I think in
a way that they never have done before.
You're seeing businesses IPOing at billions and billions of dollars that break even. They don't make any money. So there are no real fundamentals you can look to kind of quantify or justify those levels of investment. So, for me is it a Ponzi scheme? There are a lot of kind of ticks out there that say, well, it could be. But then again, as you look at it from the other side, is there really, really smart people investing in these businesses? You may argue, and Jamal does argue, that there are alternate reasons for that. But, I personally cannot believe, and I don't fundamentally believe that the private equity or the equity industry as a large is a Ponzi scheme. It's just there's too many good stories out there for me to believe that.
Also, I'll be honest, there's Rochelle and Brendan are doing at Secha Capital, which to me really just sounds like a microcosm of what Chamath is trying to do. Minus like the showboating around, like just being, doing things that matter and whatever, which is again quite rich given how you were happy to make those money. But then he was also quite honest up front, going, I need to get as rich as possible to make the difference I need to make, which doesn't make it okay. But to be fair, he's kind of walking the talk and being on brand. But I guess I'm citing you and giving you a kind of a shout out in the sense that where I'm like, I've seen how this can be done right. And I think it's a little more challenging when you're trying to wear a futurist cap and invest on the basis of a future none of us have inhabited. That will invariably feel so different to what any of us expect or, anticipate. And in that sense, some of that speculation is justified and in fact warranted. Otherwise, there'll never be money or opportunity for any of us to dream and to try things that have never been tried before. But on some level, there's a lot of danger, especially when you consider real money coming out of formal systems flowing into really untried and untested territory.
And I think the point that he gives about 40 cents of every dollar going into these deals goes towards Google, Facebook, Amazon, because you're acquiring that growth. It's not natural.
Yes.
So
it's stimulated by all that money that needs you to be at a certain level of growth or traction by the next round.
Yeah, exactly for the next round, and that's unhealthy.
So I'm hearing you guys both say yes and no. Is VC a Ponzi scheme? Yes and no, because it kind of depends.
My answer is no.
No.
I also fundamentally say no, but I agree with what Chamath is now trying to do on the structuring. That's because we've done it, or we're trying to do it.
That's also because you guys are both good people, and I can vouch for the work Convergence Partners and the value they've created. Also, family offices tend to be about that value. They're trying to literally make the Oppenheimer name last into another 100 years.
Absolutely.
And I suppose the thinking there might be very different to say the average VC.
It's not traditional VC or PE. Absolutely
not.
Yeah.
And neither is Convergence Partners.
Absolutely.
Also
it's all impact investment. Yeah.
We have hybrids up in this building.
Yeah.
Like to think so.
So folks, listen, we're going to have to leave it here. I want to thank you both one last time. How did we get all that in? That's incredible. Thank you so much for your views. First of all, one half of the founding management team at Secha Capital, Rochelle, Valap. Shout out your homie, Brendan. You guys are co-MDs. In a pretty functional relationship. You guys should get a prize just for that. Brendan Mullen, of course, being the other half of Secha Capital. Shout out to you, but thank you for being here.
Thank you for having me.
Rochelle.
Really fun.
And then, of course, Grant, the founder and CEO of PhilTech Consulting, of course, in partnership with Convergence Partners and Stockdale Street. Shout out to the Oppenheimer family, for letting you into their glow.
Absolutely.
Yeah, they're going on a pretty solid, their track record speaks for itself. We'll leave it there, certainly. But thank you so much for being here, Grant Phillips.
Absolute pleasure, guys. Thanks very much for your time.
For sure. So, one thing left to thank you, our audience, for tuning in. We love you, fam. You are our village. We'd love to hear from you. If you have any thoughts on any of the topics that we've touched on throughout this episode, you know what to do, folks. You can find us on Twitter and Instagram at African Roundup. You can find us on Facebook, facebook.com/African Tech Roundup. Yes, we're captured. We have to be on Facebook. And, of course, drop us an email. We'd love to hear from you. Drop us a voice note. Send us a voice note via email. hello@africantechroundup.com is where you can do that. Otherwise, nothing left else to say except take it easy, Africa.